12 federal.
All right, welcome everyone here to the live stream. My name is Kyle. Here with me is Dan Frio, as always. And what we're going to do, this is a little bit different than what we normally do here. Normally, we just kind of go through home buying questions, which you're absolutely welcome to leave those in the chat, and we'll answer those. But we're also going to watch the Fed announcement live. And Dan, can you kind of walk us through why is this important for us to talk about this? Because we see it starting in about 24 minutes here. The announcement we already got from the Fed, and then how that impacts mortgage interest rates.
So sorry, folks, we started 5 minutes late and we missed it. So the Federal Reserve came out today, and Kyle, if you could just chart up the CNBC, just basically their main site, you can see the markets are rallying. So the Federal Reserve came in today and they said that their Fed holds rates steady, but indicates 3 rate cuts are coming sometime this year. So we're going to see basically the stock market, which you saw right up above. If you just scroll up just a tad, see what the Dow Jones, NASDAQ, and S&P were basically zero 4 or 5 minutes ago. Now the Dow Jones is up 180, Nasdaq's up 100. You're seeing that. If you could show up, bring up the MBS Live, if you would. We're going to see MBS is probably taking a spike right now upwards. So you're seeing right through there the green candlesticks, meaning the MBSs are up. So we went basically from a flat market. It was actually down about 8 points previously, and now the MBSs are up 6. So let's put this into context, and let me tell you what the Federal Reserve is going to say, because they're going to come out in a half hour. We're going to listen to the press conference. It's only going to be about a 5-minute speech or so. But here's what we're looking at today. So the big news for today is we knew the Fed wasn't going to cut rates, okay? And they're going to come out most likely, and he's going to say inflation still stands sticky. We're seeing, the jobs market is still pretty much, pretty good shape. People's incomes are pretty good and so forth. But here's the biggest key to take out of this. What we want to really focus in on or listen to is what they're going to do or what the changes are to the dot plot. Okay, so what I want to explain to you prior to this, them going live with the speech from the Fed is what is the MBS and what's the dot plot? Okay, so that's a lot of questions that we get on a daily basis. So mortgage rates are basically they're not tied to a 10-year Treasury. It's not like the bank just comes in and says, okay, here's what we're gonna do for mortgage rates today. What they do is they take the yield from the mortgage-backed security, okay, the MBS. They take the yield from that, and then they add in what we call LLPAs, loan level price adjustments, and then a profit margin. Okay, that results in your final rate. Okay, so that's why we really focus in on the MBS market, the mortgage-backed securities market. It's basically a bond that trades on Wall Street that you can even buy in your investments. So let me explain how a bond works. So it doesn't matter if it's just a bond that you're seeing on the MBSs or a corporate bond or a Treasury bond. Here's how bonds work, okay, in its simplest forms. As the price goes up, the yields come down. Okay, let me make this simple for you. Let me show you an example. A coupon, let's say the mortgage-backed security bond has a coupon at the end, and it's going to give me a par value back. And that par value is going to, let's say it's $100. Okay, so when I turn in my mortgage coupon to whoever the investor is at that time, they're going to give me $100 back. Okay, so let's go over a scenario where the prices go up. So in today's market, I give you $50 for that bond. All right. Now, next year, I turn in my coupon, my mortgage-backed security bond, and you give me $100 back. So that's a low price. What's my yield? I give you $100. You give me $100 back. It's 100%. I doubled my money. Okay. So now let's raise the price and see how the yield comes down. Okay. So let's say that in its simplest forms, let's say today I give you $100 for that bond. Okay. So I give you $100 and you give me the bond. Next year, I give you the bond back and you give me $100 back, because remember, that's the coupon value. That's what the value of that bond is. So I give you $100 and you give me $100 back. That's the higher price. What's my yield? 0. I give you 100 and got 100 back. So you see how when the price goes down, rates go up. So we love when the MBS market is rallying because rates are coming down. So that's what you're going to see based on this information. However, I think the bond market's basically on hold right now because what they're really focused in on today is what's called the dot plot. Okay, so here's what's happening. So a lot of people keeps coming back and they're like, the Fed isn't going to reduce rates. They never said that they were going to reduce rates. Well, that's not accurate. Okay, because last December, the Federal Reserve actually pivoted. What they did is they stopped raising rates, okay? But they came out with their dot plot, okay? The dot plot. Kyle, can you pull up the dot plot, please? So
Sure
the Federal Reserve, what they control is what's called the federal funds rate. It's not the mortgage rate. It's not your car payment rate or anything. It's basically the federal funds rate. When one bank needs money from another, this is what they pay. But it has a trickle effect on all short-term maturities like credit cards, personal loans, car loans, and things like that. That's why when you see when the Federal Reserve was raising rates, all those short-term maturities were increasing in rates as well. But you're really, the mortgage rates are tied to what's called the mortgage-backed security bond. Okay, so this is what the Federal Reserve put out last December. Okay, this isn't me. This isn't anybody else. This isn't any analyst. What happens was when the Federal Reserve meets, every member of the Federal Reserve puts a dot where they expect the rates, the federal funds rate, to be in the future years. So you're seeing on here 2024, 2025, 2026. That's what's going to happen. So you see where we were in 2023. The federal funds rate currently is at 5.25 to 5.5. There's like a spread there. All right. So you could see down right through there, it's right there. That's where we ended 2023. Now, if you looked at 2024, there's dots everywhere. The majority of the dots are fitting around 4.5 to 4.75. Okay. So that means if we're currently at 5.25, 5.5, rates are going to drop 0.75%. Okay. This is from the Fed. When the Federal Reserve usually makes changes, what they do is they make changes in increments of 0.25 or quarter point changes. So this means there's most likely 3 rate cuts coming. And then if you go back, to where we won't have to do this, but when Kyle first popped up the CNBC news, it said, Fed says that they're going to reduce rates by, 3 cuts. So this is all coming from the Fed, guys. So a lot of times when I come out there saying, rates are going to come down, this is from the Fed. People are like, no, you're lying. You don't know what you're talking about. Well, you just go to the dot plot. That is given to us from the Fed. And that's their dots. So basically, if you look at it, and you can see through 2025, 2026, they expect the rates to keep coming down. Why? Because they're hoping to get inflation back in check. But why they don't come out and just say, okay, we're cutting rates today or whatever, the stock market's still doing very well. Between that and cryptocurrencies and other things, people still are feeling pretty wealthy. Okay, so that's why their concern is if they come in now and saying, oh, we're going to cut rates, Well, the markets are going to rally like you're seeing right now. Like the Dow Jones is already up 120, NASDAQ's up almost 100. And you can see right there on the screen, the MBS market just spiked. Again, it was down about 8 points at the beginning of this. Now it's up 11. So that's almost a 20-point swing. That means rates are going to come down maybe about 0.1, 0.125. That's what I'm expecting in rates. So that's basically what's going on today. That explains basically what the MBS is, and how to work those numbers and figure out what's going on there. That actually explains the dot plot and how the dot plot was a signal from the Fed actually back in December that there are rate cuts coming. They're just waiting for that data to really give them the whatever, everything they need to come out and finally say, okay, guys, we're going to cut rates. Because the problem they fear is things that's happened in the past. When they cut rates in an economy like right now that's not that bad, the markets are just going to rally and everything else, and we're going to be back to FOMO in stocks, cryptocurrencies, and housing again. So look at it this way: if mortgage rates plummet, you're going to have FOMO back in the market. And a lot of people always, I had a conversation with somebody yesterday, and they're like, Dan, you're a mortgage guy. I saw you on YouTube. I'd like to get your information about what's going on with a lot of this stuff. But you're a mortgage guy, so you ultimately are going to keep saying house prices are good and this and that. Let me just put one context in here. We did actually, other than like 1 year back during the crash of 2008 to 2010, 11, I had one bad year. Other than that, it was crazy because what happened was, as the housing market just was crashing, you have all these investors coming in, just sweeping up all these homes. We were busy as all get out. And then the people that didn't sell or were able to keep their house because of the crappy non-QM loans, we were able to refinance them with government programs like HARP and things like that. We were busier then than we've ever been in the past. So I don't really, I'll say it this way, and this is probably a bad way to say, I don't know and don't really care, I guess, if the housing market, comes down in value. I feel bad for us that owns homes, but it's not going to crash my business, because think of it. If house prices just dropped, 10, 20% across the board, people are going to be buying like crazy. That's going to actually make us, I'll say it this way, more money, because more and more people are going to be buying. Right now, it's a difficult time because nobody knows, you have existing home buyers or owners that are sitting on a fantastic rate that don't really want to sell. And then you have others that are just sitting there saying, what am I going to do? Sell at this price and buy, higher, so forth. So the market's just completely stagnant right now. Okay, so another question I want to go talk about just briefly while we wait for this is the NARS thing with the realtors. Okay, guys, this will change how things are done, but it's not going to completely change the market. Okay, it's not like, well, now realtors can't make money from the buyer and this and that and this that. They'll figure out a way to do this. You're talking usually 2-3% of the sale of the house. What people are going to do that are buying, that have the money, they'll pay it. The people that don't have the money, they're going to go back to the seller and say, well, if you pay the commission on this, we can sell your house, because the buyer would love the house, but they just can't afford your commissions. So, what do we do there? If I'm a seller and I need to spend or, give another $2-3 grand, and I need to pony that up to sell my house, I'll do it. So it's not going to be, this is going to crash the market once again. You're going to have those fear mongers out there saying, oh, this is going to completely revise the housing market. Never going to be the same. House prices are going to do this and that. Guys, it's that part of it. And the last thing, and then I'll shut up and you guys can ask questions. You're starting to hear all this bank stuff. Banks are in really bad shape, and banks are this and banks are that. Guys, it's another smokescreen. You saw, remember last year, if you guys do remember, there was Silicon Valley Bank back out in California that it kind of went under, and then the FDIC came in and resolved it and everything else. Remember, that was supposed to be widespread. All the banks were supposed to be, insolvent, going out of business, and you had maybe one or two. Now, one or two is worse than, is better than 3 or 4, but it's worse than 0. But back in 2008, I don't know if people remember this, between 2008 and 2010, there was over 400 banks and financial institutions that went out of business because of the collapse of this whole mortgage system and the housing market. In today's world, you're going to have failures here and there, but you're not going to have a dynamic failure of banks all across the system. It's just a nice little talking point that people get you to click and say, whoa, this is really bad, but things aren't as bad as a lot of people are making them. So that's it, Kyle. Whew.
Hey, that's a nice little, can we get like a little applause? I need an applause button in here somewhere.
Come on, guys, give me some clapping down there. Let's see some hands or something.
At least give Dan like a thumbs up in the chat or a little, the little clapping emoji. Cool. Let's go through some questions here really quickly. So if you guys got
questions, please bring them on. I'd love to clarify some of this stuff for you, especially if you're a realtor or mortgage person out there.
I want to reiterate too, for people who might just be tuning in right now, what we're looking at is the mortgage-backed securities market, basically. So we're looking at the bond price. And so this has a inverse relationship to mortgage rates. So as this chart goes up, interest rates take the opposite direction. So when we see green here, even though the price of the bond is going up, that means mortgage rates are going down. So that's what we're expecting here. So if you're just tuning in and seeing this chart go up, it doesn't mean mortgage rates are going up. The price of mortgage bonds go up, which makes the interest rate on mortgages come down. Let's see, we got Andy in here saying they will not cut rates until June or July. Real estate, just ambiguous. Real estate just became a member. So all of real estate's backing you. Thomas tuning in from Saudi Arabia. Dan, I enjoy your channel. I'm watching to monitor trends that may affect my Phoenix home.
Thank you so much. Awesome.
Let's see what else. Joel said, when is an FHA appraisal ordered after payment has been made? Excited to close on my first home. Thanks to Dan Frio for getting me approved from Buffalo, New York.
Good job, Joe. So when is the appraisal ordered after the payment has been made? Basically instantaneously. So Joel, Patrick's working on that for you. That order will be placed. What happens is we'll get in contact with the appraisal management company. They'll then reach out to the selling agent, make all those things. And then once they get out there, usually within about 48, 72 hours, we have the appraisal back. And then Joel, you'll get a copy of it. When we get a copy of it as well, Patrick will send you a copy of that. So thank you so much for joining us today. And thanks for using our services, man.
Just a little tick lower here. Let's get back to some cool.
What you're going to see right now with a lot of this, it's going to stay stagnant. It did rally up a little bit, but the biggest thing we're going to see here, we're going to go back to the MBS Live, folks. You're going to see this. What's going to happen in about 9 minutes, the Federal Reserve Chairman Powell, he's going to come out and speak and also start taking answers. And I can guarantee you there's going to be a bunch of questions about the dot plot. Once they release that, that's when you're going to start seeing these numbers really move, because they're going to give us a time frame on when they expect these moves to take place, and that'll give the markets more direction.
James B said, just to clarify for those confused, each dollar of reserves held by the Fed is an IOU issued by the Fed to private banks. Private banks sell Fed assets in exchange for these reserves.
Thanks, James.
Sellers are not going to be paying a buyer's agent. It'll be interesting to see how it shakes out. I think with the amount of confusion already amongst everybody, home buyers, sellers, real estate agents, I think it's going to take some time for us to see this all kind of play out and how it's going to work in the market. I don't think it's going to be immediate because no one really has a good answer to this.
Right. But the thing is, when they make comments like that, and I don't mean to point out that person, but you're making a broad statement that nobody will. I'll tell you what, if my house is selling at a price that I want and I got to pony up $4 or $5 grand extra to sell my house because the buyer doesn't have it or whatever, I'm doing it. So when you make a comment like that, nobody will be doing that. Well, you're wrong, because I would do it. Kyle, would you pay $2-3 grand extra to get out of your house to sell it if that's what it came down to? And you're assuming that maybe as a seller, I increase my price $5 grand and then give that $5 grand back to you to use as the concession or the amount to pay the realtor. But I apologize. I asked you a question and jumped on you.
You're good.
What would you do?
Yeah, especially for someone to handle all the work for me, because there's quite a bit of work involved there. Let's see, James B. James B's got a few comments in here. The assets the Fed buys are typically government bonds, bonds issued by the federal government or entities sponsored by the federal government, Fannie Mae, provide funding to the mortgage market. Buying or selling government bonds shift the vertical supply curve in the federal funds market. Let's see.
But the Fed was buying mortgage-backed securities in about $40 billion a month back during quantitative easing. So I love your comments, but the Federal Reserve does. They're not buying right now. I agree with you, but they were, and that's what artificially drove down the rates back in 2-3 years ago. So they were loading up, and now what's happening is they're not actually selling those mortgage-backed securities yet. That would even hurt mortgage rates even that much more, putting that much more supply into the market, with the limited demand that there is right now. So, but yeah, I agree with you 100% what you're saying. But the Federal Reserve can, and they have in the past, bought mortgage-backed securities.
Loan officer who cares said, "Do you feel there will be a rate cut today?" Just joined and not sure if you answered. No rate cut today, but expectation of 3 rate cuts this year. What's a good website to monitor mortgage rates closely? If I was doing
My
Mortgage
YouTube
News
channel.
Daily.
Honestly,
That's true.
if you watch my YouTube channel every morning for 5 minutes, I'm going to tell you exactly what the news is, where rates are, and what the MBS market is doing, and then click it and move on to your day. Because it's really hard to find a live mortgage-backed securities ticker without paying a lot of money.
Yeah, let me pull up Dan, the rate update. I'm going to pull up your channel here real quick. If people aren't already on there, here we go. The rate update with Dan Frio is going to be Dan's channel there. Let's see. Thanks, Dan, for your information. Drew said, "What's a good strategy for determining when to buy? When rates come down, do you want to take that one first? When's a good strategy for determining when to buy?"
Yeah, I mean, Kyle has a good strategy when you're financially ready. It's like buying a stock. You sit there and you're like, "Oh man, why didn't I buy it?" Or what, and so forth. There's never the perfect time. It'd be nice if there was the perfect time, everybody would buy. It'd be like, okay, January 12th. You ever see those videos where on March 7th, the world is going to end? And then March 7th of the next year comes, and March 7th of the next year comes. You're like, I thought it was ending 2 years ago. So there is no really perfect time to buy. Again, if there was, everybody would storm into the market and you'd never be able to buy. When rates come down, good luck timing it. When rates are going to come down, how about if they come down incrementally, over a year's time or so forth? So when do you jump on that? Do you expect sales prices to go up? I expect sales prices to basically be stagnant. Now, what happens is, as the rates come down and it makes the housing payment a little more affordable, people are wanting to buy homes. Well, there's not a lot of homes. So what actually makes a price go up and down? It's basically supply demand. Okay, so what we saw back in 2008 is there was millions of homes on the market that people had to sell because they were facing foreclosure because of subprime mortgages. That was the true reason behind the crash. Okay, so you had house prices just tumbling because everybody and their mother was putting their house up for sale before they lost it. Okay, what do you see now? Well, you basically see hardly any inventory in the market. You don't see a lot of sellers. So now what you have is you have limited buyers because of where rates are. But if you had very good rates, so let's say rates went back in the 4s, you'd see house prices go up again because everybody would be bidding on them again. So I'm expecting if rates just stay steady here, the housing market is going to be just stable on prices. You're not going to see a huge inflow of houses being purchased. So you're not going to see a huge amount of houses coming to the market. So again, the only thing that would cause the house prices to go down is a flush of homes to the market. We don't see that. We don't see that in construction. We don't see that in foreclosures, and we don't see that in existing home sales. So that's basically what's going on there. But unless rates get down to a point where it puts more and more existing homes back on the market, that's when you're going to see, house prices maybe go down just a tad. But I expect basically a repeat of last year, unless or until the latter part of this year when rates get into, I'm expecting the low 6s. And that's when you're going to see a whole new group of people coming into the market to buy.
Mina, you said, when is the next Fed meeting where they'll discuss rate cuts outside of today? Here is the calendar of meetings here. So we had one in January 30th, March 20th, which is today. You have one coming up April 30th, and then May 1st. Here's the rest of them here. I won't list them all out. But you can also Google the Fed meeting calendar, and you should see this pop up for you.
It's usually about every 6 weeks, but 4 times a year, they come up with a dot plot. the dot plot, and that is what's coming in today, and that's really what we're looking for, because the dot plot is going to give us the direction of what they're going to do. But the Federal Reserve, let's see, can you go back to the CNBC ticker, because they just came out with something else.
I sure can.
Right there. This guys, this is live right now. So Fed raises GDP projections for 2024, but still sees 3 rate cuts coming in coming year. So this is from the Fed, guys. It's not me. It's not. So when you then have somebody say Fed's not going to cut rates, well, they're telling us they're going to. So I don't know if they're in fact going to do it, but they're doing it. And this is what you're seeing, the reactions in the market.
What do we got? 1:45 until this starts. Let me just come over here and just make sure I can monitor that. Let's see. Frank said if the Fed cuts rates into rising inflation, we'll see hyperinflation by August. Let's see what else we have here. Hello, guys. The economy is going to be very worse. Please inform everyone, be carefully on spending. This recession will start after elections. Okay. FYI, I do custom architectural design in the Houston metro area, and it's become very busy, new and remodel. We said thanks a lot to both of you in here. What do we have? A minute here? Just want to make sure we don't miss the beginning of it, because they usually start pretty quick. There's a misconception. I don't think we have enough time to answer this question, but there's a misconception how much a good realtor on the buyer side actually does. So it'll be interesting to see how the commissions collected change, who will be hurt the most. I think a lot of first-time buyers are probably going to be hurt by this, mainly because if sellers aren't paying for the buyer's agent, in a perfect world, the buyer would get a 3% discount. The amount of commissions that would have gone to the agent would either be discounted off the price or be given as a credit to the buyer in the form of a seller credit. And I don't think we're going to see a trickle-down effect to home buyers. I think sellers are going to be able to continue listing their homes at the same price without having to take a reduction on the price of their home. So really the person who's going to be hurt in this mainly, I think, is going to be first-time buyers. All right, they just turned it live to the camera. Do you want me to pull this? I'll pull this up on screen here.
Sometimes it takes them a little while to get there. But
we'll
folks,
keep this here, and I'll keep it muted until it's ready.
So what we're going to listen to is the first, the federal chairman Powell is going to walk out. He already has something scripted. You can actually compare the script that he reads this time versus what he read last time, and there's usually 1 or 2 lines that change. That's about it. And then what's going to happen is people are going to start asking questions. All those people there are going to ask questions. There's got to be somebody out there that's going to ask the dot plot question, and that's the main thing we're focusing in on, because I haven't read anything yet, but they keep saying that there's 3 rate cuts. They're signaling remains that there's going to be 3 rate cuts, but I don't know if he actually came out and said it, because I haven't read anything from what the Federal Reserve posted yet. So that's what we're really intrigued to find out today is, is he going to tell us when these rate cuts are? Because I can almost assure you he's not, because he doesn't want basically they're letting all the cat out of the bag. They're telling us what they're going to do. They don't want that to happen, because, you would see the markets, the stock markets just rally like crazy, and you'd see the bond market, mortgage-backed securities just crash on this news.
All right, here we go.
So here he comes. So let's listen to what he says, and then if you guys have questions as he's talking, please post those, and we'll try to come back to those after the fact.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong, and that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the
Technical difficulty?
Is that audio not coming through?
No. Can anybody hear that? Give us a thumbs up or down if you can, please.
It looks like the audio stream stopped for some reason. There's not really a way for me to get that back at the moment.
Okay. Let me see on my end if I can get sorry, folks. This is what happens when you do the live. Kind of cool though. All right, so while you're working on that, I'm checking to see if I have audio on another system. But let me do this. Let's just go over what he just spoke about briefly.
I'll see if I can get it back.
Okay, we're working on that. Can you go to maybe another site and pull it up? He said substantial things are taking place in regards to inflation. It's coming down dramatically. There is still a strong jobs market. That's why I'm anticipating a soft landing. I'm thinking prices are going to come down, but we're not going to have a huge spike in the employment numbers. Okay. The next thing is reduced security holdings. Now that's one of the things that we were talking about. Remember when I said, somebody said, well, I think James said, what happens is the Fed goes in and buys government bonds. I also said that they also buy MBSs, mortgage bonds. In one of the comments, he stated, and you guys might not have caught this, he says they're reducing their security holdings. So what that means is they're selling these bonds into the open market, actually making more of them available. So you have Treasury bonds, like government bonds, you have mortgage-backed securities and corporate bonds coming to market, but now you have the Federal Reserve also selling into this market, adding to the supply. So that's what's artificially right now as well, keeping mortgage rates and interest rates high because of this. So that's that part of it. And GDP 2023 was at 3.4. They're expecting it to be 2.1 this year and going forward to be about 2%.
As labor market tightness has eased.
A recession is basically negative GDP over a two-cycle period. Go ahead, I'm sorry.
For whatever reason, the software is not pulling in the audio. Is not pulling in the audio stream.
Okay. So folks, that's basically, that's kind of what we wanted to get through, just to show you kind of behind the scenes. A lot of you guys probably don't watch, when the Federal Reserve comes out. Can you guys hear me talking? If you can give me a thumbs up or down, that would be appreciated. And we're so sorry about the audio on the live stream from the Fed. We apologize about that. It's just technical issues that we're having right now. So if you can let me know if you guys can hear me at this point. And then if you guys have any other questions, please read them, go through those with us. We'd love to answer any questions that you have. Tomorrow, what I'll do is I will come up with my morning video tomorrow. I'll go over the new dot plot that they pushed out, and then what the projections are. I'll read all the data, the transcripts, and everything this evening. Tomorrow's video, I'll come out, let you guys know what the anticipation is on the rate cuts based on the new dot plot that's coming in, and so forth. So if you have any other questions, let us know. The rest of this is what would happen is you have people from CNBC and reporters all over the country, all over the world. Actually, they'll come out and they'll start asking Federal Chairman Powell questions. One of those questions that I really wanted to find out was what their expectations are, or what the numbers look like on
At
the
minimum,
dot
I can
plot.
give you this.
Okay, so that's what this came out.
This is on the live
Just
stream.
now?
Yep.
Okay, so you can see right through here. Let's compare that to the dot plot that we had. I have it up on the screen. So what you're seeing right now, look at the dot plot for 2024. You can see basically the consensus is right in the middle. That middle is basically 4.5. Okay, so right now the Federal Reserve is at 5.25 to 5.5. So that means they're going to cut rates 0.75%. This basically confirms that in the year of 2024. Now, when? That's the conundrum. If I knew exactly when, if the Fed knew exactly when, they wouldn't have these dots all over the place. Now, these are members of the Federal Reserve, folks. So if they are kind of at odds on what's going on, how am I supposed to know? But you still have people coming out there saying they're not going to cut rates and they're not going to do this. Please, next time you hear somebody say that, say, well, the Fed's dot plot, basically tells us otherwise, and just leave it at that. And they probably won't have a clue on what you're talking about. It just hopefully makes them feel a little bit stupider, I guess. So that's the dot plot. But yes, if you guys have any other questions that you might have for us, love to answer those for you. So we can go from there. If you do not, again, we appreciate you guys being on here. We appreciate you educating yourself on home ownership. And basically that's the report for today. So we just wanted to do the live event to show you guys kind of live what the Federal Reserve has done. And we're highly anticipating the dot plot.
You want to go into some questions here?
Yeah, absolutely.
Okay. Other than asking directly, is there a way to know which lenders have overlays? Really, no, other than asking the lender which overlays they have. Really is the only way. There's not like a published set of like overlays. Kai said, can you get approved for a house if you had 2 different jobs in 2 years? Or does it have to be at the same employment? You want to take that?
Yeah, it doesn't have to be. It can be 2 different jobs. As long as it's the same line of work. So let's say if you're an accountant and you're an accountant here, and then you're an accountant over here and you're an accountant over here, that's fine. We can just loop them kind of together.
Do you hear that like clapping thing that just happened? Or is that just on my side? Oh, some weird clapping thing that happened. Okay, let's see. Is there a way to sell your property to an LLC that you own? If so, how will these high rates affect that? You don't have to sell your property to an LLC, but if you have a LLC that you just want to put the ownership of your property into, if you have a conventional loan, you can just do a quick claim deed with a title company. It probably costs, I don't know, $100 to have them get that recorded, but it's just a quick claim deed. You don't have to like sell it to the LLC. It doesn't trigger any due on sale clause with conventional loans. Can you purchase a home in a trust's name?
Yes, some banks will allow it. Some banks won't allow it. It does get to be a little bit sticky. So the first thing you'd want to ask is, I would be upfront, especially if you're going to use us. Let us know you're trying to close it in a trust. We'll make sure we don't have any issues with the lending side of that or the title side when they're vesting the ownership of the property into a trust. But yes, you can do that with certain banks.
Let's see, and then. Any advice for first-time homebuyers when the rates drop to 6.5 or lower?
Yeah, hurry up and get pre-qualified and get a lot of offers ready, because when rates drop to 6.5, honestly, they dropped to 6.5, 6.25 to 6.5 in November. We were like crazy busy through the holidays, and I've never been as busy as we've been. Like December, January, we had record December, Januaries. Believe it or not, I won't say record ever, but by far within the last 2-3 years, especially purchases.
Yeah.
Back in 2000, early 2000s, everybody was refinancing. There was a lot of people buying. There was a lot of people refinancing. But when rates hit 6.5%, you're going to have a whole slew of new buyers into the market. Thus, you're going to have more demand. What happens when demand goes up? If you don't have much more supply, prices are going to go up, folks. I'm not saying that because I'm not a doom and gloom sayer or whatever. That's just what happened. If you took economics 101, that's what you learn.
Yeah, and there's just so many people waiting too on the sidelines that by the time that rates do drop and then you want to get into the mix, it really wasn't. You're not going to have as much available to you. So I think being at that spot where you're approved and waiting on the sidelines is a lot better than waiting and then trying to get approved afterwards when everybody's trying to flood at the same time.
Well, let me just say this. I get it, guys. The high prices of homes and then insurance, went up 50%. For some of us, it doubled. It sucks. It sucks. But, I'm not keep saying that house prices are going to stay here or go higher from here just because I'm in the mortgage business. If home prices dropped, 40% over the next year, we'd be going crazy. So I'm just telling you based on the facts, what's going to happen. I'm not trying to be the doomsdayer or the one applauding home prices. I don't make money on home prices. We make money on transactions, and last year was really bad. So we need transactions, and you don't have it, like I'm saying. So if you don't have a lot of transactions going on, the housing market's just going to be stagnant.
Mm-hmm. Cool. So want to walk through really quickly kind of what we do. So we work in all 50 states. We lend in all 50 states. And so we have this really easy process. So you can go to winthehouseyoulove.com to schedule a call whenever you'd like, whenever it's convenient for you. You'll do a quick 15-minute application. From there, we'll show you your quotes and your loan options. And then is when you can shop for a home. And the nice thing is, there's no pressure to buy. And like we were mentioning is so many people, I think, are going to end up in a spot where we see interest rates do start to come down. And then everyone's going to want to get into buying right at that moment. And you really want to be able to step in whenever you want because you're already ready. So being pre-approved and waiting for a home is a lot better than waiting. All of a sudden you're ready to get into it. And then you're trying to fight the crowd, so to say, to get in, to find or to be able to make an offer on the house that you want. Let's see. I've been a realtor for.
Somebody asked me a question yesterday. They called me. I think I said this at the beginning of the video. They called me and they said, "Dan, you're a mortgage advisor. So what do you do?" Well, I apologize about that, guys. I'm a mortgage loan officer. Okay, we're brokers. We're loan officers. I consider myself a mortgage advisor because I love consulting with you guys, because doing this stuff. I don't want you just to call and put in an application. We run your stuff, give you a rate and whatever. I love interacting with you. Here's programs you guys qualify for. You guys know we have 3 grant programs that are revolutionizing home buying right now in a lot of areas, up to $10,000 grants that we have right now that don't require any paybacks. So these are things that we can help you with. We are loan officers licensed in all 50 states as well as Puerto Rico. The benefit of this is we're one of the country's largest mortgage brokers. So that's how we can get away with one application pool, one credit report. We're going to shop you. Currently, we have 73 lenders in our stable. So we can lend at the bank's level here at the bank at Allied First Bank. And we're also one of the country's largest brokers, giving us access to 73 of the country's largest companies. So that's truly what we do.
Okay. I've been a realtor for 16 years. It's super slow right now. Hoping it picks up for realtors, lenders, inspectors, and appraisers. Also appreciate your positive feedback on the NAR settlement.
Trinette, where are you coming from? I'd like to know where it's slow, because a lot of times, I'll get texts from people and comments from people. They're like, it is crazy here. So I'd love to know where you're from.
How does a rate buy down work and how much can you pay? So there's 2 different types of buy downs. There's a permanent rate buy down and a temporary rate buy down. Temporary rate buy, let's talk about permanent buy downs, because that's probably what this person's talking about. A permanent rate buy down, think of it like prepaying interest. And so you'll pay money in what's called a point, and 1 point is 1% of your loan amount. So if you have a $300,000 loan, if you pay 1 point, it's $3,000. So that's money that you would pay upfront. Points are not required. A lot of lenders will kind of put them into your quote, assuming that maybe you aren't aware of it. We run into a lot of buyers who their lenders are charging them $11,000 plus in points to get a lower rate. And the buyers feel good about it because they're like, oh, I got a low rate and no one else can match it. It's because you're paying all this money up front. Any lender can charge you points if you ask them for it. But basically what happens is you pay the money up front. It's going to be in Section A on a loan estimate. And what will happen is paying money up front then can lower your interest rate. And so from there, we're taking a look at the upfront cost versus the monthly interest savings. How long does it take for you to recoup that money? Okay, so you're looking at the interest savings compared to the upfront cost and saying, doesn't this make sense? Will I effectively get my money back in 3 years, in 5 years? And that's the main thing you're looking for in a rate buy down, is making sure that you don't get a buy down that's going to take 7 years to pay off, because odds are you might be able to refinance in that time, or you might sell your home in that time. And so that investment upfront wasn't worth it. So it's basically just a way for you to be able to pay down or to lower the interest rate by paying upfront money, kind of like prepaid interest.
Kyle, can you do me a favor? Can you pop up what's the MBS markets doing? I don't know what it's doing.
Yes.
That's what I'm just asking. As Federal
Yes,
Chairman
I
Powell
can.
talks, I love seeing the reaction in the markets. We got the Dow Jones up right now, just shy of 300 points. Okay, well, we're now up 13, and we were down at the beginning of the day. We were at 100.47, so we're up 22 points for the day. You understand what I'm saying? If you look at over at the right, folks, you can see 100.47 all the way over to the right, the going down through, and then where we are right now is 100.69. So that means we're up 22 points. That's probably going to see about 0.1% rate drop in mortgage rates. And we have the Dow Jones up 280. We have the NASDAQ down 151. So let me put this in the context. The Federal Reserve said they're not cutting rates today, but they anticipate 3 rate cuts this year. You imagine what the market would have done if he says, yeah, we're going to cut rates 0.5% today. You'd saw the Dow Jones go up 1,000 points, and you'd see mortgage rates just plummet. So that's the dilemma that the Federal Reserve is in right now, because they're like, we can probably reduce rates, but the markets are going to go crazy. So that's, if you can pop up CNBC one more time, I don't know if you have it live there. I don't mean to make you keep jumping around, but you can see so people don't think I'm full of crap on what I'm telling you. So these are the things that I pay attention to all day long, and that's what we try to give you. So the Dow Jones, again, if you read at the top, the Fed keeps for the first time after Fed keeps rate cuts outlook. So the Fed didn't cut; they're just saying they are going to cut, and that's what the markets are doing right now. And the good thing is, if you can click on the bond, tab there, we need the 30-year bond to be under. Where is it? I'm sorry. God dang it. Where is it? Go here. Hold on.
You're looking for a 30-year?
Yeah, actually the 10-year is what I was looking at. Oh, it's right there.
Oh.
We need the 10-year to be under 4.3. 4.3 is a ceiling. When it hits, it goes over 4.3. The 10-year Treasury, the markets all seem to just take it on the chin. So these are just things that we do behind the scenes for you guys. But again, we don't want to just, you apply for a loan, we do this, lock in and move forward. We want to help you with this journey.
Steven said, is it true you get punished for having a large down payment and a high credit score? So what you can do, and this is only for conventional loans, is look at the loan level price adjustment chart. And this is a chart that every lender uses for pricing conventional loans. And what it's going to do is show you the difference between down payment and how that impacts your rate. So what you're looking at here, when you see these, the actual chart has adjustments in price. And I don't want to go super deep into the weeds. Basically what ends up happening is I converted this using an estimate of 0.5 adjustment is about 0.25% change in rate. So this is the theoretical change in rate that you could see with different down payment amounts. So for instance, if we were looking at a 7% rate, just as an example, doing 25% versus 20, you would have a 0.188% higher rate if you did 20% down instead of 25% down. So in some instances, doing a lower down payment can help, but it's so marginal, right? If you were looking at doing 25% down versus 3%, you're talking about a 0.063% change in the interest rate, like super tiny for the difference in payment versus the higher monthly payment that you would get with a 3% loan versus a 25% down loan. Let's see, building a new home with a close date of May 7th. If I apply for a loan tomorrow, will I have to pay a 45-day rate lock fee? And how do I avoid similar rate lock fees?
Yeah, you don't have to go out 45 days. You can apply right now, get you approved, and we float. So there's two ways you can do mortgages. You can what they call float the rate or lock the rate. And here's my analogy. And I love analogies, so bear with me. I like Bitcoin and I want to buy Bitcoin, and so I keep monitoring it and watching it. I want to find a price point where I can buy. That's called floating. I haven't really pulled the trigger yet. But when I get to the point where, okay, I like that price and I buy it, well, I'm locked in now. So we can actually keep monitoring your rate for until we hit the 30-day mark and then lock you in with no extended fee. Or like a lot of times would I anticipate the Fed meetings and so forth. So it kind of freaks me out. So I'm like, let's lock you in now, because if the rates go skyrocketing based on what the Fed says, you're locked in. But if rates come down, the benefit of a broker, us being a broker, is we can move you to another lender to capture that lower rate. So we locked you in at, let's say 7, rates just plummeted. Now they're at 6.5. I'm just going to withdraw your loan from this lender and lock you in at this one. That's the benefit of using a company like ours that has 73 lenders.
Dante said, saying prices will go up is misleading because home prices are already unaffordable right now. Demand will go up, but what's good is demand if you can't buy it. You can want anything but can't get everything. So we're not saying with any certainty what will happen to prices. And that would be true, but what we're talking about is not theoretical demand. There's real demand happening right now with low inventory, which is keeping prices where they're at. And just because it is unaffordable for the majority of people doesn't mean that there's still not demand for people who can purchase, because that's what we're seeing. Even as the markets get more and more unaffordable, there still is high demand for people who do have the capability to purchase, with home prices being higher, with interest rates being higher. So just affordability for median price and median income doesn't equate to real demand in a real market, because we're not talking about theoretical demand. We're talking about real demand that's happening right now, which is keeping prices where they're at. And if rates lower, it would also increase demand further as well. Can you get a temporary buy down with the lender, or can that only be negotiated with the seller? As a buyer, would you recommend? Well, we'll answer that first. Yes, lender. A lot of. I thought they were talking about builder. So basically, someone has to pay for the buy down. There are some lenders who allow you as the buyer to pay for the buy down, but I don't know why you would do that. It doesn't really make sense. Really, you're either going to have the seller pay for the buy down or the builder pay for the buy down. So you don't negotiate with the lender a temporary buy down, because any lender can do a temporary buy down, but you need a source of where that money's coming from. And if you're interested, I have a full calculator on the website here. If you go to tools and then buy down calculator, it helps explain a little bit of what's happening here. So what's happening with a buy down is you're not magically getting, your rate reduced. It has the effect of your rate being reduced, but what's happening here is, let's say in this situation, you got $9,900 from the seller or the builder. That money sits in an escrow account, and then a little bit of your payment in year 1 and year 2 is being reduced by that amount. So it's basically like you put some of that money aside that you got from someone else, and they're helping you make payments on it, almost like having someone renting out a room in your home. They're helping you pay down your mortgage. And that's kind of what's happening with a buy down, is you're negotiating where that money's coming from, so from the seller or the builder, and then you are that escrow account's helping you pay down the monthly payment for that. So it's not really something that a lender would facilitate it, but they're not going to give you the money for a buy down like that. Naomi, if I do the pre-approval application, did we skip the other person's question?
Might have, I don't know.
Or
Steven says
this one.
he's expecting prices to go down 25%.
Oh no, I think no, he's saying he wants to put 25% down.
25% down payment. I gotcha. I was like, I don't know. My apologies.
Let's see. Drew, your second question was, as a buyer, would you recommend offering a higher sales price for a temporary buy down? It definitely would make your offer more enticing to a seller. If you're asking a seller for money for a temporary buy down, you're asking for it in the form of a seller credit. Back to this example, in this example, someone with a $450,000 purchase would be asking for 2.21% in a seller credit. And so the seller would be effectively giving up this money that they otherwise would have got from selling the home. And so offering a higher amount definitely does make your offer more attractive to a seller, because usually the seller doesn't want to give up money. And so offering a higher price can net them a higher amount. Naomi, you said, if I do the pre-approval application, how would I just get one quote or multiple quotes to choose from?
So we use actually a system to do all this for you. So you're just going to get one back from us, but it'll be the best rate that we could possibly find with over 73 lenders throughout the country. It's a computer program we use. We actually just plug in your data. We've showed that on multiple websites or live events that we've had. So we plug in your data. We've hit it. And again, is it the lowest rate in the entire country with every bank possible? No. We're set up with 73 of them. Okay, they're banks, credit unions, mortgage companies, and so forth. So that's what we do. We plug in your data, we hit the button, and it just rallies up. It's like going to Amazon. You're buying the same thing. It's just giving you different price points. So think of it that way. You're just going to Amazon, plugging in, what kind of rate you can get today. You hit it, and this is finding you the best one that matches you. And so we're going to send you back that quote, because why would we send you? I can send you 50 of them. But it wouldn't do you any good. It'd be like, okay, I'm giving you $200,000 for this house, and this rate is 5, and this one's 7, and this one's 9. Do you want those other quotes? I would just rather come back to you with that 5% and say, here, are you comfortable with that? Let's get you locked in and move forward.
Let's see. I thought points are primarily used to help people get approved. Also, buy down points aren't to be confused with origination points, right? Okay, so paying points can help reduce your interest rate, which can lower your monthly payment. However, you'd have to pay a lot of money in points to have enough of an impact on your monthly payment to help you qualify. Unless you were like super on the line of qualifying, paying points probably isn't a super effective way to help you get approved for a loan. And if it did, it would cost you quite a bit of money up front. So this would only be for someone who had a lot of cash, but also a lot of debt, where they're really tight on their monthly payment. So I don't often see that points being used as a way to help people get approved for a mortgage. And then buy down points aren't to be confused with origination points. So origination points are something that the lender charges either for the origination fee or as basically discount points to lower the interest rate. And then buy down points, I'm confused with what they mean by buy down points, because there aren't buy down points, like it's not really called that. Do you think they mean like the amount of money you'll need for the buy down?
No, I think it says also the buy down points, the money you're using for the buy down isn't the origination points, because you might be paying an originator a fee. Like I've seen one, I have one here today. I get loan estimates all day long. This one there's no points, but the loan origination fee is $4,234. And the other fee is $995. So no points or fees or anything, but they're getting charged $5,300 in basically fees. So
I see.
Yeah, one can be points, one can be origination, but just treat them all as it's a cost. It doesn't matter the label in front of it. It's a cost for the loan.
Yeah. Cool. So what we'll do this live stream again next week, same time, well, actually we're going to do it at 3:30 Eastern. We did it a little bit earlier today. So what you can do is, if you're ready to get started with getting pre-qualified, and then just, if you want, you can wait on the sidelines until you find the right house, or until maybe rates are a little bit better for you. You can go to winthehouseyoulove.com, schedule a call at a time that works for you, start an application. You can show you your quotes and the loans that you qualify for, and then you can go ahead and shop for homes whenever you're ready. So thank you all for being here, and we'll see you all next week.
Thanks so much for coming. Take care.